Audio check. Audio check. Audio check. Gupta. A very good evening to all of you. Hope all of you are doing well. So, thank you all for joining the webinar today. So, our agenda for today's webinar is to talk about our two new NFOs. The first being Mirae Asset Nifty Energy ETF, and second being Mirae Asset Nifty Small Cap 250 ETF. Both of these schemes are passively managed schemes and they'll be tracking their respective benchmarks. So what I'll do over the call, I'll quickly cover fund presentations for both of these funds, and in the end we'll have a short Q&A session. So let's start with the very first fund, that's Mirae Asset Nifty Energy ETF. It's an open-ended scheme that's replicating the Nifty Energy Total Return Index. So the NFO has started from today. It's going to be there till November of 4th, and the scheme would be reopening for continuous purchase on November of 10th. So let's quickly start. So the energy sector, I believe this sector requires no introduction, right? From the homes we live in to the highways we drive in, from the industries, from the manufacturing or the internet that that's getting powered by these power sector or the energy segment. Energy sector is that sector that powers every other sector of the economy. So let's look at some key highlights of this sector. So India is currently the third largest energy consumer in the world, and we are the third largest consumer of oil in the world. You see the millions of vehicles, you can just know with the population effect how India would retain that third spot after the two developed and emerging economies, US and China. Also, we are the second largest refiner in Asia. We plan to double our outputs by 2030, and the growth is not just limited to non-renewables, it is also across the renewable segments. So to reduce the dependence on the non-renewable segments, India has increased its solar renewable capacity as well. So as of March 2025, India's solar capacity exceeds 100 gigawatts, making it the third largest solar producer globally. Looking to one more fact, that India has targets of having a solar capacity of 500 gigawatts by 2030. So you can see the government's ambition plan shows that how we want to reduce our reliance to the non-renewable segment and reduce and increase focus towards the other renewable segments. Let us look at some of the key milestones of this segment. So India generates close to 1,800 billion of electricity units. Our CNG stations have 10x in the last 10 years. They're right now at 7,700, and they were 10 years back they were somewhere around 738. The number of LPG connections have doubled. Just look at the solar capacity, for instance. We were just 3 gigawatts back in 2014. Right now, we are over 100 gigahertz. And as I previously mentioned, this number is expected to increase in this next decade. Now let's talk about how is the per capita power consumption vis-a-vis global peers. So if we have a look at India and the population, India's per capita power consumption is quite less compared to other developed and emerging economies. India's average is just one third of the global average. So going forward, there are high chances that there is going to be increase in this number. And with an ambitious target of being the third largest economy, the energy per capita is certainly going to increase in the coming future. Now, when we talk about the energy theme, right? Energy is made up of many sub segments, right? Or many sub sectors, I'll say. It may be oil and gas, it may be power, it may be renewables. So let's have a quick look on each of these subsectors. The very first subsector that I'll talk about is the oil and gas ecosystem. So a typical oil and gas ecosystem can be divided into three stages. First is the upstream, where an oil company would be digging for oil reserve. It would be involved in the exploration. Classic example can be ONGC and Reliance. You see those oil wells, or you see the ocean drilling that goes on to find oil reserves. That's an upstream company. The second is the midstream company. So as the name suggests, midstream, it would be used for processing, transportation and storage of this crude oil and natural gas. And then comes the downstream companies, from which we fill petrol on a day-to-day basis. That's the refining or the oil marketing companies. So companies like IOC, BPCL, all these are example of downstream companies. And then finally we have the end users. There will be various consumers like your industry, whether it be a household, whether it be a aviation. So and every end user would be classified in these consumers and industries. Coming to the next subsector, that's power. Similar to oil and gas ecosystem, power also has three stages. The first is generation. What do I mean by generation? Those companies that are involved in generation of power to thermal, gas, nuclear, non-renewable or renewable segments. Then is transmission. What does transmission mean? How do we transport that electricity that is already generated? So transmission companies are those that are involved in movement of electrical energy through networks. And finally, you have distribution companies. Those are the ones that make the electricity reach to your and to the end user. So overall, your power value chain would again have companies classified in each of these segment. A company like Power Grid would come in a transmission segment. A company like Tata Power would be always also be there in the generation segment as well as the distribution segment. And the overall ecosystem is overall value chain is quite big in this particular sector. Talking about the other part, that is renewables. And this is the place that has drastically grown in the past decade. Within renewables, we have four major sources. First is wind, second is solar panels, third is hydro, and then we have nuclear. Out of that, wind and solar panels are the one that dominate the entire renewable scale. So if you see the capacity growth, it has certainly happened in these two sectors, in these two categories, I'll say. Now, when I say that India would our power output would double by 2040, or our requirements would double, or we'll become the second largest energy consumer, let's say, how does this demand come from? Where does this demand come? So it primarily comes through segments like manufacturing, it comes through segment like data centers, it comes through segments like cooling. So if we talk about India in particular, we expect two segments, that is industry and cooling, it is expected to drive more than 70% of this incremental electricity demand in India in the next 5 years. So when we say that the output is going to double, it's going to be major. Sorry, there was a minor connectivity issue. I believe the screen is now visible. So we'll quickly just start from this slide again. I'll be sorry for the connectivity issues. There were some issues while connecting to this network. I hope I'm audible right now. So I'll just resume from where I had started. So we were talking about the power capacity mix. So if we have a look at the power capacity mix right now, majority of the power is generated through thermal energy sources, that is coal, petroleum products, oil and gas. Then we have the next largest segment, that is renewables. That is the second largest contributor. But there's one key thing that we have to observe over here. If we see in the last decade, initially majority of your power was generated through thermal energy sources, and if we have a look at today, you can see that the pie share is now shifting towards the renewable segments. So the share of renewables is now started to increase. And why is it happening? Because though our coal output is increasing, but there is a supply demand mismatch. And that's the reason you will see that majority of our focus is now towards increasing power generation through renewable segments. And if we talk about the renewable capacity trend, majority of the power is generated through solar, and then followed by wind, and then by the other categories. Solar today occupies a lion's share of close to 64% of the total renewable capacity. Remember the number that I had mentioned in this in the past decade, that number was just at 3 gigawatts. You can see how in the past 11 years our capacity has increased more than 100 gigawatts. And the second contributor to this renewable story is the wind energy story. So, India is right now undergoing a decade that is marked by rapid renewable adoption, and our whole focus would be here to reduce our dependence on non renewable energy sources like coal and oil and gas. If we talk about the investments in this space, so investments in the generation segment are expected to double in the coming decade. So right now the investments are close to 8 trillion. By the next 5 to 7 years, you'll be expecting more than 19 to 20 trillion over the next 5 to 7 years. And where is this going to invest? Where the investment would be taking place? It's going to take place mostly in the generation segment, because that's the place where it needs to be addressed. I think someone has raised their hands. We'll be answering the Q&A later. Uh, Coming to the next part, if we talk about the power capacity, so the power capacity that we are eyeing at by 2030, the power capacity is expected to reach close to 700 gigahertz, and again it's expected to double in the next 5 years. Coming to the next subsector that I want to talk about is petroleum. So, whenever we talk about the story of oil and India, the first thing that comes to our mind is that India is a large importer of oil, right? But there's a lesser known story on the other side, that we are even a large exporter of oil. So, so we are petroleum product exports are among the highest export category within our whole exports to the other economies, and our exports have been in the range of 60 to 67 million metric tons in the last decade. And what do we export the most? We export mostly high speed diesel, followed by petrol, and followed by aviation fuel. So, overall, petroleum exports are expected to remain steady with moderate fluctuation over the years. Now, coming to the index method, so the Nifty Energy Index is designed to reflect the performance of the sub segments that I mentioned earlier. So you will be having all type of companies that belong to the power, oil and gas segment, petroleum segment, or the renewable segment. And how is it different? You will be having companies right from large, mid, and small. That is the Nifty 500 universe. There are some checks that have been kept in mind so that the index is very liquid. So any company that gets included in this index should have a trading frequency of at least 19%. There is a listing criteria of 1 month, and each of these companies have been selected based on their free float market capitalization to have fair representation to other companies in the portfolio. The weight of each stock is capped at 10%. And if we talk about the industry exposure, we have even capped the index industry exposure at 25%. Why is it done? Again, so that other segments like power, renewables, oil and gas all have a fair representation in the portfolio. The next is index rebalancing. So the index is rebalanced twice in a year. So there will be constituent changes in March and September. And finally, we'll be having a portfolio that is of 40 stocks based again on free float market capitalization. If we talk about the performance, so Nifty Energies Index has generated a return of 18.8% in 10 years. It is again around 4% extra than Nifty 500 and 5% extra than Nifty 50 index. It has even delivered a decent performance in the past 5 years. Past 1 year, the Nifty Energy Index has been laggard. It's again, as energy is an energy as a commodity is sensitive to cycles. So last 1 year, the index has returned negative 20%. But if we see on the long term, you can see how it has outperformed the broad based indices like Nifty 50 and Nifty 500. If we talk about the calendar year performance, you can see that during commodity cycles, like if I speak of a year like 2016, where there was an oil rebound from 30 to $60, you can see how this index has outperformed the Nifty 50 and the Nifty 500 index. The same happens on the other side as well. During a year like 2014, we saw oil crashing from 100 to $60, right? At that point of time, the index did return. There was the returns delivered by the index were very less compared to the broad based index. And then there's a year like 2021 again, when there was a good amount of exports that had happened, crude was stabilizing. So you can see at that instances also the Nifty energy index has outperformed the Nifty 50 and Nifty 500 index. So what the point that I'm trying to make over here, as a sectoral index, or as a thematic index, it is going to be sensitive to commodity cycles, and there may be a period of underperformance where the commodity prices are, or let's say flat, or they are in a downtrend. But during up cycles, you will be seeing a good amount of outperformance over the broad based indices. Talking about the industry classification, so why do we need to look at this particular segment? So when we talk about the Nifty Energy Index and compare its exposure to other broad-based index, if we compare it to a index like Nifty 50, it only has 12% overlap. If we compare it to a broad market index like Nifty 500, you can see the stocks present in Nifty Energy Index have just a 13% weight. So you are getting an exposure that is very underrepresented in market cap indices like the Nifty 50 or the Nifty 500 index. And that's one reason you can see how you'll get a very differentiated portfolio over here. And if we talk about the exposure, as a previous point where I talked about industry capping, you can see how there is industry capping in the power segment, or let's say in the oil and gas segment. You'll be having no industry that's crossing the 25% mark. So your even the newer industry like renewables, they will be having also a fair amount of representation in the portfolio. If we have a look at the portfolio is of 40 stocks. Again, the top stocks are the large cap ones. So you have industries like from refineries, from power generation, from coal, from gas suppliers, from electrical equipment. Then you have renewable players. Then you have the power distribution and transmission players. So overall, you are getting a very diversified portfolio across the power and the oil and gas sectors. Now, coming to one more point, why someone should look at it, right? So, the very first thing, that India's energy demand is going to double in the next 10 years. You can see how our per capita power consumption was very less compared to other global. It was just one third of the global average. So, in the coming decade, there is going to be an increased amount of capacity added across the power segment, and there are factors that are going to drive it. Structural factors like data centers, increased EV adoption, cooling demand, all these things are going to drive the long term consumption demand. Again, you are getting a very different portfolio. The stocks present in Nifty Energy Index, they have just a 13% weight in the Nifty 50 and the Nifty 500 way. And finally, being a passive product, you are getting a pure play low cost exposure in the energy theme. So what we'll do now, we will quickly move towards the next fund, and then we'll take questions at the end. So the next fund that I'm talking about, that's Mirae Asset Nifty Small Cap 250 ETF. Again, a passive scheme that's replicating the Nifty Small Cap 250 Total Return Index, which is the benchmark for active small cap funds. So I believe small cap as a category require no introduction at all. But just for everyone's ease, we'll just quickly cover where does a small cap fit in. So if we go through a life business life cycle of a company, your company starts from an idea phase to a growing business, then it stabilizes, and then it's a mature player, right? Your small cap do fit in the young growth or the embryonic phase of the company. They are usually they are usually present in the youngest growth phase of any company's business life cycle. If we talk about why is it why does small cap investing makes and how is it different from the other categories? Okay, so let's take some names. You have a company like Bajaj Finance, right? So today a large cap player, right? But Bajaj Finance again started from a small cap company, and you can see where it is today. Then take a company from a different sector like Aurobindo Pharma, or take a company like Eicher Motors. All these were once small caps, and today they are large cap companies in the top 100. And why do these companies outperform? Like how, like why they grow? There are certain attributes that they bring in. First of all, they have a possibility of becoming a leader, right? They can stock re-rating can take place very fast. And once an stock undergoes PE re-rating, you can see the price increases rapidly. Then these companies are in they are in the early stage of their business cycles, so again they have higher chance of gaining market share. And finally, small caps give you exposure to themes that are not present in large cap and mid caps. For example, hotels. Majority of your companies are today present in small cap. Talked about B2B PLI segment. You'll see majority of the companies they'll be present in the small cap segment. So overall, small cap offers you many benefits compared to large cap as well as mid cap. But again, that comes with a risk, because we say that yes, the business will succeed, but there are again chances of it going through a failure. Now, let's have a look at the investable universe, how it has evolved in the last 5 years. So, back in 2020, your small caps, first largest small cap company had a market cap of 6,900 crores, and your largest mid cap company had a market cap of 30,000 crores. And just have a look at the number in 2025. You can see how in 2025, the largest small cap company has a market cap of 30,000 crores. So you can easily say the small cap 2025 bucket is much bigger than the mid cap 2020 bucket. So overall, they have evolved a lot, and we have seen increased amount of interest both from retail as well as institutional side. If we look at the changes in the Nifty 500 index, so earlier large cap dominated around 80% of the Nifty 500 universe, and small caps were a mere 7%, or with a market cap of 9 lakh crores. Just have a look at the number in 2025. Today, large cap share has reduced to 67%, and small cap companies now have a 11% market cap, 11% share in the entire market cap. Out of the 387 lakh crore Nifty 500 market cap universe, 44 lakh crores comes from these small cap companies. And now small and mid are more than 33% of this entire Nifty 500 universe. What does this signal? That there is a good amount of interest in mid and small cap companies. Now, when we say, like a few moments back, I spoke of an example like, let's say, Bajaj Finance. The same thing has happened in the mid cap space. You have seen companies transitioning from the small cap to the mid cap space. So, this slide shows how, on a 6 monthly basis, there are companies that would be shifting from small cap to mid cap. For example, can be BSE. BSE recently shifted from a small cap company to a mid cap company, and you can see the over a year the average inclusions from to a mid cap from a small cap are around 20 stocks. So over the years, this opportunity has enhanced, and you can see how in before the 2020 or the pre-COVID era, this upgrades were very less, and small cap was a totally different space. If we talk about industry exposure, small cap does offer you a very differentiated exposure. An industry like sugar, textile, majority of them are present in small cap. Or industry like hotels, like 75% of the companies are now in the small cap space. Talk about companies like hospitals, infra, you will see majority of them being tilted towards the mid cap and the small cap space. And your small caps typically have lower exposure to the stable or the large cap companies. Like you'll be seeing less of banks or the large banks or the IT companies. But again, you will be seeing exposure to the newer IT companies or the newer small finance banks. So overall, small cap gives you a very differentiated exposure across different industries. And again, the growth of sectors has been immense. Just have a look at a sector like oil and gas. It has grown from, the market cap has grown from 9,400 crores to 1,14,000 crores. That's a CAGR of 52% in just in the past 5 years, 5 to 6 years. If you look at a sector like IT services was somewhere around 17,000 crores in 2019. Right now, it's at 1,17,000. So the point that I'm making over here, there are many segments that have seen immense growth in these 5 to 6 years. And when we say small cap, right, the first thing, हाँ इसकी तो market capitalization कम रहेगी. But the overall market capitalization of small cap has increased tremendously. I'll say, in fact, they are no longer small. The average market capitalization for the Nifty small cap index has grown by 7x. At in 2015, that number was just 2,600. And look at the number. It has grown 7x as of 2024. And then comes the interesting part, multi-baggers, right? See, we all are chasing those stocks that may give us multi-bagger returns, right? And again, interestingly, majority of these stocks belong to the small cap bucket. So the multi-bagger stocks, just for everyone's information, are those that may generate 100% returns over a specific period. And if we look at the number of stocks that have given multi-bagger returns in the past 5 years, it has again small cap lead. It is again the small cap space that is leading the charge. So there were 58 stocks that have grown more than 5x in the past 5 years. There are 42 stocks that have grown 3x just in the past 3 years. So overall, you can see small cap tend to have great potential to being a multi-bagger in an investor's portfolio. Now, talking about the index, so the Nifty Small Cap 250 index, so it's a very simple index. It would be investing in the top 250 small cap companies. The eligibility is very simple. The company should not form part of the Nifty 100 and the Nifty Mid Cap 150 indices. The weight is simply computed based on the free float market capitalization. And again, the index is reviewed on a semi-annual basis. It's reviewed twice, once in March and second in September. And if we have a look at the portfolio, you'll see the top stock has a weight of 2%, right? So in small cap, there's one thing you'll see no stock having a exposure as big as 10%, the same that you see in a large cap index like Nifty 100 or Nifty 50. So here you have a very diversified exposure. So even if even if your top company or the top 10 companies underperform, you won't be seeing a very drastic attribution taking place, or you won't see your portfolio going down by very much. So it's a very diversified index, I'll say. The largest market capitalization in the Nifty 500 is close to 50, in the Nifty small cap 250 is close to 52,000 crores. And the average market capitalization of the small cap index is close to 18,000 crores. You have average weight of 0.4% to each stock. And the median weight is again around 0.35%. If we have a look at the sector, we had already seen it earlier how like what kind of exposure you get through the small cap. You can see in large cap indexes, a sector like healthcare or a sector like media is not present, right? But just have a look in just have a look at the exposure in the Nifty small cap 250 index. Healthcare as a whole has a exposure of close to 14%. Then have a look at a sector like chemicals. Chemical has just 0.6% weight in large cap, and in the small cap the weight is as good as 6%. So again, you are getting a portfolio that is diversified across different sectors. And if we have a look at the performance, so out of the three market cap market cap indices, mid cap leads the charge, but the next best performing segment is the small cap 250 index. Over the past 10 years, the index has generated a return of 15.6%. In the past 5 years, again, it's leading the charge. It has been the best among the category. The overall return generated by the Nifty Small Cap 250 index was close to 28.2%. But also at the same time, we have to acknowledge the fact that small caps do carry higher volatility compared to large and mid caps. So, an investor coming into this particular product has to be mindful of the volatility that's present in this particular segment. If we have a look at the calendar year performance, again, typically during recoveries or post crisis, you will be seeing that small cap would definitely outperform your mid cap and large cap peers. Have a look at a year like 2021 or 2009, where there's a stark difference between the returns generated by small cap and the other peers. And at the same time, when the market corrects, this particular segment would correct more. A year like 2018, where your large cap returned positive 2.6%, your small caps did correct by 26%. But at the same side, the upside is also amazing. A year like 2023, the most recent year, you can see the overall difference between the returns of Nifty 100 and Nifty small cap. The gap is huge. And if you have in look at a totality level, you can see that the Nifty small cap 250 index has outperformed the Nifty 50, 100 and 500 index in 10 out of 20 calendar years, and an overall return of 15.6% in the past 10 years. Now, again, why do we look at the small cap 250 ETF, right? So, within active, small cap is, I think, the most interesting space that investors watch out for. But then you'll have an obvious question like, I do invest in an active small cap fund. Why should I look at a passive product? So, let me just give you a number. So, if I talk about data as of yesterday, in the past 5 years, where active small cap funds on an average regular plan have delivered a return of 28.4%, the Nifty small cap 250 index has generated a return of 29.5%. The performance is even superior in the 3 year bucket. So you can see that even being of the passive nature, the scheme has outperformed more than 15 out of 21 active small cap funds. And the point that I'm trying to make over here is that you just don't stop like your active funds. You again, along with your, if you're having four active small cap funds, what you can do, you can add a fifth one as an passive small cap fund, because it's very difficult for any active manager to consistently outperform the benchmark. So your small cap 250 index can be a good value addition over here, because in your bull markets, your passive products will definitely will certainly outperform your active counterparts. And if we have a look at the other reasons, as small cap, a very large opportunity set, 250 companies, 0.4% average weight. The market cap has grown by 7x in the past 10 years. You are getting exposure to companies in the early or young growth phase. You are getting a very diversified exposure to uh, different emerging sector like hotels, hospital, textiles, AMCs. So you have a very diversified sectoral exposure over there. And finally, it's the return profile has been pretty decent, 15.6% in the past 10 years. But at the same time, investors have to be mindful that small caps have higher volatility compared to your large cap and your mid cap. So if you are entering in this world, be mindful of the volatility. But again, from an asset allocation perspective, given the current market situation, you are confused that where should I allocate, and you're finding it difficult to allocate in the small cap bucket. A Mirae Asset Nifty Small Cap 250 can be a good diversified small cap exposure, and you can again just supplement it with your active funds exposure. So that was all from my side. We will quickly address the questions raised in the Q&A chat box. Okay. Okay, so do we have the first question is that do we have YOY, YOY growth numbers and growth drivers for energy sector? Yes. So as I said, the energy sector. Yes, we have shown a slide in our, we have covered a slide in our NFO presentation where we have compared, we have shown the year-on-year increase in each of the subsectors like power or let's say oil and gas. And second question is growth drivers for the energy segment. So the growth drivers, like if we talk about the incremental demand is expected to come from segments like data centers, from heavy industry, and again a good amount of demand is expected to come from the cooling segment as well. Like if I have to sum it, the data centers combined with manufacturing, combined with the cooling, would have more than 80% of the growth drivers in the energy segment. There's one more question. Both these are ETFs. Yes, both of them are ETFs. Both would be replicating their respective benchmark. There's one question related to at the current market level, lump sum or SIP is suggested. See, small cap over the past 1 year, it has generated negative return, and the returns have been it has been trading at a premium as well. So we suggest that you can use a staggered approach to take exposure to the small cap space. No, there's one more question. Can we do SIP in these funds? No, SIPs, no, since it's an ETF scheme, uh, so it is, you won't be having a direct SIP option, but again, you can just go out on exchange and purchase at the live market rates whenever you wish to do an SIP in this particular scheme. Okay, there's one question. If a small cap moves from small cap to middle cap, are we losing a big potential? Right. So, when I talk about a company like BSE, right, I said that it evolved from small cap to a mid cap company, right? But why did it happen? The market cap grew, the price action take place. So your price action and your market cap growth would be captured in the index return or the ETF return over here. Okay, there's one question. Why not active small cap funds? So I'd mentioned the number, but I'll just for your convenience, I'll repeat the statement. So if I talk about the past 5 years data, if I take 21 active small cap funds regular plan, 15 of them have underperformed the small cap 250 index. If I give you a number, 29.5% has been generated by the Nifty small cap 250 index, and active funds at the same time have generated 28.43% return. There's one question, what is the industry share of power in this energy ETFs? So again, there's a industry capping, so no industry would have a exposure uh, of more than 25% over here. So whether it be oil and gas, whether it be the power segment or petroleum products, everything would be capped at 25% over here. Okay, what are the other benefits ETF have? There's one question. What are the other benefits ETF have versus index funds, except they can be traded on stock exchange and okay. So when I talk about uh, and if you just compare an ETF versus an index fund, it's the choice of investor that he wants to take. So if you are coming through an ETF route, you are getting the first thing that you are getting real time tracking. You can, if there is a intraday tracking, if you are buying at the morning, uh, let's say 9:15 levels, you have a option of exiting right at 3:15. Again, you get real time tracking. You can anytime exit the position. And if I talk about the tracking error and the tracking difference, the tracking error and difference of ETFs is slightly better than the index funds, and the expense ratios are also typically lesser than the other ETFs. Uh, okay, there's one question. What is the closing date of the ETF? The NFO would be closing on November of 4th. You can use our various channels to invest through it. There's one uh, question. What about the dividends? Okay, so if I talk about the dividend yield, the dividend of the Nifty energy segment is close to energy index is close to 2.55%, and any of these dividends received by any of these companies would be reinvested in the scheme. So in the end, you will be getting you'll be your ETF will be giving you returns of your dividends as well. So it would be included along with your price appreciation. So there's one question like what is the time frame? So when we talk about the time frame is close to when we talk about like product like small cap, you can have a 5+ years exposure to get to reap the actual benefits. For energy segment also, we given the structural story that India's energy sector has, I believe that can be again a good satellite exposure to take as well. There's one question like what is the index rebalancing schedule and what is the criteria followed? Okay, so in all of these stocks are weighed on their free float market capitalization, and the index is rebalanced in March and September. So any companies not meeting those criterias excluded would be excluded out of this index in that, and there is review period of 6 months. So we'll be taking cutoff dates of January 31 and June 31 to July 31 to see how's the market cap fared in those observation periods. Okay, there's one question, tactical or strategic. So see, energy as a segment, yes, it's sensitive to commodity cycles. So if you are very sure that yes, I can I can track those commodity cycles, you can take a tactical exposure. But again, given the energy story and and we talk about the demand doubling in the next decade, it it does make sense for a strategic allocation as well. From the top, there's one question like what is the all-time high? So the index is trading close to 22% discount from its all-time high. Okay. There's one question, when will power ETF? No, so this is not a power ETF. Power is going to be a part of it. So you'll be getting 25% power exposure through this particular index. It's a diversified. It's a thematic product. So you are having exposure to sectors like sectors like petroleum, oil and gas. Then you have power, and again all the subsegments that I spoke about. The taxation, it would be similar to the all the MF taxation for long-term capital gains and the short-term capital gains, similar to the other active or passive mutual fund. There's one question that will there be any plan to introduce a FOF MF? So right now we are just coming up with an ETF. So if so right now we aren't launching an fund over here. There's one more question that will semiconductor stocks get included in it? No, semiconductor won't be a part of it. That falls under the electronic manufacturing. But if there is any company that falls under the electrical equipment bucket, for example, if there is a company who is having some business exposure to semiconductor, that can be a part of. But the basic sub industry again is oil and gas, petroleum, electrical equipment, and power generation and distribution. So you won't be getting a pure play semiconductor exposure. Uh, there's one more, when the PPT, yeah, it would be published on the AMC's website. uh, there's one question, will solar energy be included in this? Yes, so solar energies would be included. You will be seeing companies like Suzlon, Inox Wind be a part of this index. So in the presentation, I did mention how the solar capacity has increased. It's right now 64% of the total renewable energy capacity. Yes, it would be, so you will be getting solar industry exposure as well in this particular portfolio. So there's one more question. Given the current valuation of small cap 250 index, what way did you what should be the approach? So yes, the current if we compare the small cap 250 index, yeah, it's slightly it's above the average, about the 5-year average. That's why we are suggesting that you use an staggered approach or the SIP approach to take allocation in this particular product. There's one more question. What is the industry share of oil and gas in this product? So the industry share is close to for oil and gas combined, it's close to 19%. So there's one question on sector, like a fund on data sector or semiconductor AI. No, right now we don't have any fund on that. So yeah, if there is, if we have, but we do plan to come with it in the coming future. What is the TER of both of these funds? Yeah, we'll be publishing it on the website. Yeah, it was not mentioned in the in this presentation. Yeah, are the metals included? No, it won't be having any exposure to metals. The industry exposure is very defined over here. It's electrical equipment, it's oil and gas, petroleum products, and power. So I think we have answered majority of the questions. So So you can visit the AMC's website for further details. Just again, I'll mention the NFO period. The NFO start has started from today. It's going to be the closing date for the NFO is on 4th of November. The allotment would be 7th of November, and the scheme would be reopening for continuous repurchase from 10th of November. So for any other details, you can visit our website or social media handles. Thank you all for joining the webinar. Hope you have